Retiring in a volatile downward market. It happens. Luck of the draw. Timing is everything. And what if you're retiring, just starting your retirement dreams in the midst of a stock market correction or a bear market? Do you do things differently? Do you react? What do you do? That's what we're going to talk about today. Welcome, Tony Shore, to the show. We're talking about retiring in a volatile downward market, and we've done this show before. We did it roughly, that's pretty darn close, 5 years ago.
Really?
Yes.
Really? Well, it's about time. We should do, yeah. I mean, I guess it's not about time to have a down market, but it's about time to do a show on the markets for sure.
Well, 2025 has started out with a bit of a volatile situation.
Just a bit.
The last time we had this conversation was during the COVID meltdown of the market. We could just replay that, but let's just revisit and redo it because the messaging is the same. But I want to talk about it because it's fresh to people, and this is a retirement-based podcast. So people watching this are focused on retirement. Maybe they just retired, maybe they're thinking about it, and they're like, well, what do I do now that the market's crazy? So let's get some definitions in first. Correction and bear market. Have you heard these terms thrown about lately, Tony, in the media, the financial media?
Yeah, correction. I've even heard the R word thrown around a little bit.
Recession.
Correction, bear market, and recession. Recession? Did I hear in there somewhere? Yeah.
The correction and bear market have to do with the percentages of downward from the peak. The recession is thrown in there. It adds a little bit of a layer to recovery time when it comes to this. So I'm going to talk about what these are, how long they last, but more specifically, what you do if you're retiring in this mess.
Yeah.
Specifically. So
yeah, it's been quite a week in the markets.
Yes. Now these terms are pretty solid, but there's some different versions of calculation. So there's always going to be some loosey-goosey nature to these. But a correction is down more than 10%, but less than 20%. And in 2025, we have a correction. We know this. A bear market is officially a bear, that's when you're down from the peak 20% or more. So we might have a bear market in the NASDAQ, which is tech heavy, which got crushed in 25.
Yeah, we're basically there.
Right, but the S&P or the Dow Jones might not be in a bear. So it depends on what market, what index you're using and so forth. Generally, I'm going to use some general estimates. We have a correction in the S&P, meaning we're down 10 or more, but not yet 20, right? We're in that range, 10 to 20 down once per year since 1950.
Yeah.
It happens.
Yep.
Now, does it happen once every year? No. Sometimes it happens multiple times in a year. Sometimes it never happens in a calendar year.
But on average,
once a year. So it happens. So corrections, and I would argue that when corrections happen, we're down 15% from the highs, people don't panic. But bears, people panic. Bears happen once every 5 to 7 years.
Yeah.
Since 1950, we've had 12 to 15, depending on how you calculate it. So we've had a dozen or so bear markets since 1950. And usually that's when people panic. So let's talk about the more recent bears, and then we'll decide whether or not we're in a bear market in 2025. But then we'll talk about what we do. But I just want to go reflect a little bit to what has happened. Do you remember the 2000 dot-com bubble?
Yeah. That was a little more than a bear.
49%
Ouch.
down.
Yeah.
Now, how do you calculate this again? Peak. So for 2025, the peak was mid-February, I believe.
Yeah.
Falling off from there. So you could, if you think about this, you could have a bear market and you could
still be up from the previous year. Yeah.
Right.
Well, yeah. Because last year, that's what's happened this year, because last year we were up, 24%, 26% overall. The market was, not we, but the market overall.
Right.
was way up. In fact, it was way up for 2 years. So when they say now it's down, well, you're probably still ahead if you count last year. But looking at this year, you're down.
If you look a year long, you could start off, go crazy up 40%, drop 30, you're in a bear market, but you're still up 10% in that year.
Yeah.
So again, though, 2000 .com bubble down 49%.
Ouch.
And then it took 7 years to recover. Now, what is recovery? Recovery is getting back to where you were when it peaked.
Yep.
Right. So that was a long one. That was
really long. They haven't been that long. They've gotten shorter at least.
Right. 2007, 2008, 2009 was the housing bubble. That was down 57%.
That was a big one. That was actually called the Great Recession. That was down enough that it was a recession, and it really hit people hard. Yep.
And it took 5 years to recover from that.
Yeah.
And then the most recent one was 2020, COVID. We were down 34% during that. And when we did the show 5 years ago, 34% from peak to trough. And that only took 6 months to recover. That was a whipsaw in that was a real short recovery time in history, in historical terms.
Yes. So
one other thing I want to point out, dividends. And how do you factor those in? So if you think about when you're down 20% or 25%, that doesn't mean the companies just stop paying dividends. If you own dividend paying stocks, they don't necessarily just say, oh, we're stopping dividends. So you're going to be getting dividends or money during that time. What do you do with that? Do you put it in your pocket or do you reinvest? If you reinvest, you're buying on the way down.
You're buying low.
When the recovery happens, you're going to recover quicker.
Yeah. Well, if you're in, I know we're talking about retiring in a down market, and that's the trouble point. But just to add a note of positivity, a market correction and even a bear in some cases, if you're still in your working years, is a good thing.
Depends how you look at it.
Because that's money you're saving for retirement, and you're putting money in. So a correction once in a while, you're buying low, and that helps you in the long run. But you have to have time on your side to do that.
Okay, Warren Buffett.
And you have to be working.
You buy when everyone else is running away, and you sell when everyone's getting greedy.
Right.
So you're right. But I want to talk specifically about those people that are retiring.
Yeah.
Right in that window. So the average recovery is 2 to 3 years, peak to the prior peak to the start of a bear. So that, I mean, we saw 7 years. We've had 6 months. So average 2 to 3 years. So when people say, well, how long is this bear going to last? No one knows. But if you say 2 to 3 years, you're in pretty good shape if you have to take a guess, which is what people are doing. So now the question becomes, well, how do you retire in this? How do you retire? How do you retire in a bear market? I want to talk about a couple that recently.
If you were working with Dan leading up to that, Dan Wendell and Dolphin Financial, it's not a problem because not all your money that you need to live on in retirement is in that market.
Correct. And I'll use an example of a recent couple. They retired. They came to me in December of last year, so 2024, and they agreed to work with me and do a comprehensive plan. Their goal, their plan originally in their heads was to retire at 65. They were both 59. So when I sat with them and ran the numbers and did the math and, projected out and did all of the comprehensive financial planning that goes into it, I let them know that they could retire immediately. They could, which blew their mind, right? Because they were expecting 65. And I didn't say you have to retire now or you have to wait till 65. I said, if you wanted, you could retire today. You could go to your boss and quit. And I gave some different scenarios. So they agreed that they would retire next year in 2027. So 2026. So what we did was begin that process of saying, all right, if you're going to retire in a year, January 2025, if you're going to give it your notice and you're going to leave in January 2026, what are we going to do differently now? because all of their money was in their 401k. They had some cash, but for the most part, all of it was in their 401k in a target date fund. Both of them. So they agreed. They started working with me, and we immediately took some of those chips off the table. And I said, all right, we're going to need money in 1 year to live. We know their budget. We created a budget, how much they're going to need. And I said, we're also going to need the money in years 2, 3, 4, 5. And we did the bucket strategy. We did a show on the bucket strategy, right, Tony?
Yep.
And we talked about that. So I
That's
created
a
a
good one.
bucket for the short term. 1 year, they need this. And then, then another bucket starting in year 5 through 7 and, so on. So we did that in January. And then, so they were taking chips off the table. They were reducing their risk. February, the market goes up, hits the peak. What do you think their reaction was? What would the typical retiree?
We should have waited. We should have left the money in there. Why did you tell us to move this money?
Right. Very typical reaction.
Yeah.
In the past, I've had.
But the markets are going to have big upswings and big downswings every year. That usually happens, like you said.
You can't time it.
No.
So I said, this is why we're doing this. Remember, we have a plan. They didn't say, "Oh my God, you're a loser." They were just like,
But you didn't have them take everything out of them.
No, and they're still contributing to their 401k because they're still employed.
There you go.
So then comes February. Then comes the high, and they're like, and then comes March. Then comes April, where the market's now down potentially 20.
Yeah.
What do you think they say then?
Oh my God! Thank you, Dan. We dodged a bullet.
No.
Oh no.
What that's the play, right? Oh, Dan, you're the greatest. No. What they say is, I'm scared. Are you sure?
Oh yeah, sure. Retiring? Yeah, because they're retiring. I'm thinking about my mindset because I'm still working. I'm not retiring next year, but yeah.
No, so now they're scared.
Yeah.
And then we meet and I say, this is normal. All my newer clients have reached out or communicated with me. I've talked to them proactively about this recent correction, potential bear, because they're new to this and they're like, I know we created a plan. That's great. If the market's going up, they're still happy, but the market tanks. They're like, wait, no. This is not, all right. Maybe we still work. Are you sure we're still on target to retire in January 26th? And I say, let's review what the math is. That money you're going to need in 26, all of 26, all of 27. Where is it? What's it? Is it down? No, it's getting a fixed rate of 5.5%. So what changed? Nothing. Well, our 401k is down. When are we going to touch that money? Oh, that one we're not touching for 9 years. Right. And so, but they still get nervous because that's just a natural thing for people. And then you get these sensational headlines, right? So how do you retire in a bear market? You plan in advance so that the conversation goes that way. You build the income plan. You avoid sequence of return risk. We've done shows on that. You don't want to sell in a bear market. You don't want to retire in the summer of 25 when the market's down 20% and now you're selling 20% lower. The reason
if all your money is in a 401k, a traditional 401k or a traditional IRA or a traditional TSP or 403b, what have you, an employer-sponsored traditional account where it's tax deferred and it's all in the market, right? You would be worried if you're planning on retiring next year or right now. If you're planning on retiring this year and your money is like end of the year and your money's all there, you might have to work a little longer. You might have to have a different plan, but you should be working with a trusted financial services professional who doesn't have all your eggs in one basket if you're that close to retirement. Is that what you're saying?
Right. You're not looking for growth anymore. You're looking for distribution plans.
Right. And it's good to have some growth.
And it's not, you don't want to have it a switch.
Right.
All right. We're in growth. Now we're in distribution. No. Because what if you hit the switch in the bear market? That's what I'm saying. You want to gradually go into it.
Yes.
Right. And cash is king right now. Right. So high yield savings. We've done shows on how much you should keep in cash. That was one of the most popular ones. CDs, multi-year guarantee annuities. These are paying over 5%. The high yield savings and maybe closer to 4 now. in 2025.
Yeah.
But you could have locked in a CD for 3 years or an annuity for 3 years paying you 5-6%. And that's looking beautiful right now. So I've gotten calls from my other clients that we've done that, who said, man, I'm getting 5% and the market's up 20 last year. Why did we do that? Why did we should have stayed in the market? That's, you get it. This is just natural. This is what people do. But then they call me this month and say, I am so happy we did that. I am not sleepless worrying about my accounts going down.
Yeah.
Right. So do you have the money set aside for this drop? Right. So that's the key. That's how you retire in a bear market. But Tony, what if you didn't? What if you didn't do this advanced planning? What if you were planning to retire in the summer of 2025 and you're looking at your stock portfolio and it's down 15% right now?
And that's where all your retirement money is at.
And that's where it is. Right.
Attached to the market. And if it's in a 401k, that's where it's at, or an IRA.
Or you don't
typically.
know. You don't know where it's at.
Right.
But you hear the headlines. Trump's going to destroy us with the tariffs, or it's a new world order, or whatever. And you're in the market, or you don't know. You don't have a plan. You know you want to retire in 5 months or a year, but now you're scared. What do you do then? You never sat down and figured it out. So your options, there you have options. It's not the end of the world. You can work longer, like you said, which is my least favorite.
Yeah.
Right.
I'm sure it's most people's least favorite.
Right. You could decrease spending, which I would say is people's even more least favorite. Maybe that Trump's working longer. I don't want to spend less. I'd rather work longer than stop spending on my fancy records and LPs behind me.
Oh,
I mean,
okay.
Did I say that?
Personal, getting personal.
Sorry.
Tear.
You have to revise your numbers. You have to maybe rebalance your holdings. Now, when I say rebalance, revise, you have to go back to the drawing board. Now, if your plan was, I'm going to leave it all and take 4%, I'm just going to let the market ride, 4% rule. Yeah, that works over time, but sequence of returns can destroy the 4% rule. The 4% rule means you're going to take less out, right? So now, all right, revise your numbers. We're going to have to spend less. Rebalance. People need to think that through. So maybe you have to rebalance where your money is. Instead of having so much in the market, maybe you move some to cash, or maybe you move some cash into something a little bit more income producing, or a 3-year bucket or something like that, 5-year bucket. And then finally, a strategy that most people don't think about that I think is a really good one to consider, everyone's different, is home equity. So you have a home, and that's a huge asset, probably paid off, close to it. There's probably a couple of $100,000 or more in equity sitting there. Why not tap into that to get you through a bear market if you didn't plan in advance already? So this is specifically for the people that do not have a plan. And maybe the home equity was part of the plan. So now you're like, okay, I guess we talked about this. Market goes down and I need money. I burn through my cash because this recovery is taking a year. Now I go to my home equity. Not the end of the world, but people think, So there are options. You just need to start talking and thinking about them. You can't bury your head in the sand. Right?
Don't bury your head in the sand.
Don't bury your head.
It's good to know.
No one likes sand. I live right around the corner from the beach. I hate sand.
It gets in everything.
So don't panic. Start thinking about these options. It's not the end of the world. But again, when's the best time to plant a tree? 20 years ago. Second best time today. So look at these. Don't think, all right, I'm going to have to work longer because I didn't prepare. Market's down 30% and now I'm in trouble. Don't say, what other options do I have? I don't like people working longer to buy health insurance. There are other options, or to avoid drawing down in a negative market. There are other options. One other thing I want to bring up, Tony. Mid-range issues. You don't talk about this. Oh, Dan, I have my bucket strategy. I got cash for 2 years. It's literally under my pillow. Not a good idea. but maybe you have them stuck between your records, so no one's going to look there.
Right.
What do you do for those people that are saying, okay, I got my bucket strategy, so I don't need this money for 4 years, so I'm putting it in the market? Well, okay, what are you projecting that return is going to be? Oh, I'm projecting 8 to 12% returns, because that's what Dave Ramsey says. I can get 12%. Okay. So you're projecting that, and then in 5 years, you're going to have, double your money. No, you're not. Because if you're down 30 now and you're not going to touch it, that's great. You can touch your cash while you're in the recovery. That you're not getting that 8 to 12% return. You're hoping you get back to even. So now everything's got to shift. Your pool of money that you need in that 3 to 5 year window is not necessarily going to be as high as you were projecting. So you're going to have to rethink some things. So that's why it's important to, maybe the 10-year money you don't care about, right? You can see that, but that midterm, you need to be thinking about rebalancing and maybe having investments that are income producing, not necessarily growth oriented. So, these
It
huge
gets tricky
returns, right? You can't just do it. Oh, I'm going to get my 8% return because that's what the
market. You have to make adjustments along the way. But I think, Dan, the key to everything you've said today and the answer to this problem, I know you have a conclusion, but my conclusion is you have to work with a financial professional like yourself and get a plan in place. And then actively every year you look at what's going on, make the adjustments needed. That's just the way it works. Right. You're going to sleep well at night if you do that.
Don't be reactive, be proactive. So have the plan, but then once this happens, revisit it and tweak it. I have my short-term money for 3 to 5 years. Even people like I said, even those that have that money set aside and it's not at risk in the market, they still worry because it's natural to be scared because everyone else is worrying. Especially the younger people that are still working, they're like, oh, when there shouldn't be, right? If they're doing it right. But the sensational headlines draw eyeballs. CNBC is going to say, we're in a correction, we're in a bear, and they'll put the big, the images. And then you'll have the guy that's been saying, I told you we're going to have a bear. You've been saying that for 7 years.
There's a bear just ripping someone apart, a camper apart.
Right, and the bull is like bleeding. It's got its horns clipped. They do this. And you're going to have the people that are doomsday sayers finally coming out saying, I told you so. I told you so. So I don't say I told you so, even though a lot of times it's like, oh, you should have been thinking it. No, don't get swept up to that because that's what people do. And you don't want to miss those up days because you miss like 5 or 6 up days, the biggest up days in a recovery, you're not going to recover. And it's a random up day. Like in 2025, we were down. Then we had that huge up day when Trump said 90-day pause. Like if you miss that, and now you're like, oh, maybe
that's one of the top 10 up days probably in the last 20 years. So, and they do say in the last 20 years since 2005, if you missed the 10 best up days in the market, 10 days out of 20 years, your returns would be cut in half. And if you missed 20 or 30 of those top days, you would go way down. I mean, way down.
Right. And so what you do is you don't want to be whipsawed by making, rash moves.
Yeah.
So what my recommendation is you take the possibility, the possibilities are endless as to when to sell, when to buy, and you shrink them and you say, well, I'm going to not try and time this, but my returns are going to go. They're going to get the window is going to be, I'm not going to have a -30 to positive 40 potential return. I'm going to shrink it. And now I'm going to go from -5 to positive 15. Boring, yet so much better when you're retirement.
Yeah.
You know what I mean?
Yeah.
It eliminates a lot of the panic. So that's it. Don't panic. We talked about, and 5 years ago, you quoted Douglas Adams, right?
Yep. Don't panic.
And bring a towel.
And the answer to the life, the universe, and everything is 42. We don't know the exact question, but we know the answer is 42. But don't panic. You see the bumper stickers. You maybe read the book. Don't panic. But Dan, before we go, you should let our listeners know how to get a hold of you. You offer a no charge, no obligation consultation. And this isn't an infomercial or anything, but people need to have a solid plan in place or get a second opinion on where they're at.
Yeah, I do a lot of second opinions, a lot of initial, all right, I'm thinking about retiring.
Yeah.
Unfortunately, a lot of times it's, hey, I'm retiring this year. What do I do?
Yeah.
But it's better to get that in advance. And I do those. I meet with people, and sometimes I tell them, you're fine. You don't need me. You know, everything's good. But a lot of times I'll say, hey, here's what I would do.
Yeah.
And I could tell everyone that for free. I don't charge for those initial consultations. That's just the way I do things. Because they may not like me and I may not like them.
I don't know what's not to love, Dan. I mean, my goodness.
Easiest way, go to dolphinfinancialgroup.com. Watch these videos. There's a link below. After this, you can comment, you can write in there, or you can connect with me or call my number 888-508-5935. I'm going to put it on the show right here after this. Once I kick Tony off. Thanks for a good show, Tony. We'll catch everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.